Hi, everyone. Welcome to the show. Today we have a special guest, and that's Des O'Kell. Des is the president and founder of Enterprise Group. Welcome to the show, Des. Thank you very much.
Well, thanks for having me. You mentioned founder. I co-founded the company with Leonard Jarosik, who's CEO and chairman as well. He's away at the moment, or he'd join me on an interview like this. That's for sure.
Yeah. So Enterprise Group is a oil and gas services company. You service the industry. You founded the company, I believe you mentioned 2004. So you're 20 years in, co-founded the company. But how I want to start the conversation, Des, is operating in the Alberta oil and gas industry comes with ups and downs, right? We had, the up and down right around 2007, 2008, slowdown in the industry, build up, and then once again, a major slowdown starting in 2014 with the drawdown in the price of a barrel of oil. So let's talk about resilience. Obviously, you're operating in a cyclical industry. How did you get through the most recent downturn in the industry starting in 2014?
Yeah, well, good question. That 2000 it was late 2014 when the deterioration of the WTI and Brent oil prices. If you remember. The shale revolution down mainly in the Bakken and the Permian and so forth, and Marcellus was really coming on strong, and Saudi Arabia was really looking to teach them a lesson, the shale revolution in the U.S. and they really stepped on the production gas pedal and overproduced, basically taking down the price of oil on the world market, and it really didn't work out well, really for anybody, even Saudi Arabia, because what they tried to accomplish really didn't come about. But what it did do is it really damaged, commodity prices worldwide, and it basically created here in the Canadian energy market, it created what was a 7-year low activity period for us and all of us in the Canadian sector. That 7 years didn't start to uptick to better capex spending in the development field for our Canadian producers. It didn't start upticking till Q3 of 2021. So 3 years ago is when our Canadian players started increasing their capex. It ended that 7-year downturn. In the Canadian energy services space, half of our players just didn't make it out the other end. What I can say about Enterprise is in all 7 of those years, we were cash flow positive. We weren't earnings per share, but we were cash flow positive through every one of those 7 years. And I don't think many of our peers and competitors that were listed issuers anyway, I don't think they could say that. So we really did a number of things during that period. We entered that 2000, or exited 2014 with right around 50 million in debt. We looked a little different at that point. I think our revenues were well over 80 million. 20 plus million in EBIT at the time. So we're in a pretty good condition operating. But, with that bit of debt that we had, and of course, activity levels really compressing, we did a few things. We had 2 underground specialized construction businesses. One was a tunneling business, and the other was an underground utility installation, so high voltage power and fiber optics and natural gas lines and what have you. So these 2 businesses, we were able to, in 2016, we sold the underground utilities installer to Quanta, which is out of the U.S., Houston-based. I believe they're about a 16-18 billion dollar a year company. They were up here in Canada making some acquisitions, and we were able to sell the company at a very, very good valuation for us. And I think we sold the business for just over 20 million, applied that straight to the debt. 2 years later, we sold our CT tunneling, our tunneling business, very, very specialized, sold it to a competitor for also very, very good valuations, banged down the debt. So we got to about 2018 and we were almost net debt free. And during that time, we were starting to look at retooling our power fleet, which kind of fast forward puts us into that nice position that we're in today. So well before the uptick in our Canadian energy economy, we started to look at some new innovation. And basically, part of our site infrastructure that we provide for our clients, one pillar of that is mobile power. They're out there in their project sites, well away from any infrastructure. It's very remote, frontier in many cases. So they need mobile power to come to site to power the entire site. That's one of our pillars that we have in our fleet. And historically and traditionally, for decades, diesel has been the incumbent. Now, what we started to look at was instead of bringing out several diesel units onto site and all that thousands of liters of diesel being consumed, we started looking at bringing out one larger natural gas unit that was able to power the entire site needs. So instead of having 6 and 20 kilowatt units at every light tower, and there might be 6 or 10 of those on site, and 100 and 150 kilowatt units to power the office structures and everything, that's a lot of units on site. Just bring out one large natural gas fired unit and a microgrid, and everything plugs in. Right? So there's a bunch of efficiencies with that, but we were the first to start that. And at the moment, it's 5.5, almost 6 years later, we really don't have any competition, any comprehensive competition in what we're doing. And as we get on to this, talk that we're having here, we can talk more about what we've done to sort of position ourselves at the very, very tip of the spear in our business. But generally speaking, to answer your question about that downturn is, that's how it went. It was a struggle for everybody. Like I said, we lost half of our peers and competitors in the service business, but we came out in a very, very premier position as a site infrastructure provider to. And if you look up and down our client list, it's a pretty fabulous set of names that are very recognizable, many of them tier 1 players.
Who would you name as your top clients? Are we talking about Canadian Natural Resources, Suncor, Conoco, Chevron?
Yeah, all those. ConocoPhillips, Murphy, Petronas. We've got a few, foreign players that have pretty good, significant pieces of development here in the Canadian basin. Such as the Murphy and Petronas, Pacific Cambrian, which is an Indonesian-based private business. They're the folks that are behind wood fiber LNG. Mm-hmm. So they have a wood fiber LNG has a facility on the west coast of Australia that has been producing and liquefying LNG for a number of years now, and they're building a LNG project in Squamish on the west coast, just north of Vancouver, kind of in the on the coast near Whistler. Mm-hmm. So that's a foreign player. Their production company, their producing company in Canada is called Pacific Cambrian. So they're also a decent sized client of ours. Others that you might recognize, Whitecap and Birchcliff and many of these, yeah.
It's a great story of resilience and then rebound, and especially with that competitive advantage that's forming now in your shift from diesel operated generator to natural gas. There's obviously benefits and advantages to your clients, of which you have many blue chip oil and gas companies. But almost the elephant in the room, Des, I think for a lot of oil and gas services companies, not to discount what you're doing, is the cyclicality again. And so for the future, is there a strategic planning around diversifying your industry mix and who you're serving to fill in those downturns?
Yeah, well, there's kind of two things I can say about in response to that. First of all, we've taken this leadership position, certainly in the mobile natural gas power systems, and we've started to build our fleet over the last few years now around the gold standard in turbine technology, and it's the manufacturer out of the U.S. called Flex Energy. It is an absolutely stunning piece of IP and technology because of its how it burns the fuel, its incredible emission profile, and its ability to operate in the conditions that we're operating in. I mean, many of our clients are operating in areas very remote, very north. Temperatures, it's not uncommon to find yourself at minus 35 or minus 40. This turbine is rock solid all the way down to those temperatures. So when you're looking for, usually turbine technology, if you're in the right conditions, they can stay on nearly 100% of the time. So reliability is premium with a turbine. But the Flex unit has a few of these other tremendous benefits to their technology, and of course fuel tolerance is one of them. One of the things that why we started to move towards natural gas, because so many of our clients are producing natural gas on site or nearby where the project is. There's an opportunity to use their own fuel, so they don't pay anybody for that fuel. And these sites are consuming, in diesel, they're consuming, thousands of liters a day. So if you can take that fuel, switch it to natural gas, have the client provide their own gas out in the field, they don't pay anybody for that fuel. But one of the problems with that is that now you have different fuel qualities. Okay, so if you've got solution or flare gas or production gas and our Flex unit can handle H2S, basically right up to about 6,500 parts per million. So it can take some pretty interesting quality of or poor quality of gas and still properly combust. So this fuel tolerance is really one of the major benefits of it operating in this environment that we're project to project like we're doing. So it really is the winner. So when we were able to lock up that exclusive arrangement with the Flex manufacturer, it really, that moat that we already had sort of built, it really fortified it. And now, to answer your question is, now, we're not looking just at the energy sector. There's other adjacent industries where we have, hand fits into glove just nicely. We're taking a very, very strong and focused look at the mining sector. They are in the incumbent, out there when they're building mines and they're operating mines, they're in the diesel world, right? So there's opportunities there. There's other away from grid or away from infrastructure construction. We've already supported a number of construction projects with this mobile power. So there's other opportunities that we can start branching out. And 2025 is when we're going to have a very, very serious look at the mining sector, which we've had a few conversations with some mining leaders, and they're absolutely interested in the opportunity. There was a second opportunity there we're talking about is, we've got, just this year, we had the Trans Mountain expansion line open up and start shipping crude oil in May 1st of this year. And then, of course, we've got LNG Canada, the big Shell Canada, with their four Asian partners, Petronas being one, Mitsubishi, Korea Gas, and another Chinese company that escapes me. But basically, they are at the ownership of LNG Canada. They've finished the liquefaction plant. The pipeline is finished. They're going to be pressuring up the pipeline here shortly with natural gas, and they're looking at shipping their first cargo to Asia in possibly the second quarter of 25. So those two elements, you got to remember that the history of the Canadian energy sector, we've used either our production here domestically, and then the majority is one client. It all goes to the U.S. With these two lines, these two opportunities, this is the first time Canadian production will access the world markets. And when you talk about cyclicality and what have you, many in the industry feel that these two opportunities, both oil and LNG getting to other parts of the world market, will take away a little bit of that lumpiness or that cyclicality that we've I don't want to say enjoyed, but there is cyclicality, and when you've got one large customer being your only player, your only taker, there's a much different dynamic now to the world market and how Canada plays a role in it.
What does the prospect, and I hope it's a likely prospect in 2025, of a administration change in Canada from the Liberals to the Conservatives mean for a company like Enterprise Group operating in the oil and gas industry?
Well, certainly, I will say that Trudeau and his current 9-year administration have done really what they could to kneecap the hell, not only out of the oil and gas sector, but the natural resource sector across. They've done no favors to mining or forestry either. But there's no doubt about it. He's tried to kneecap at every turn the energy sector, and in spite of all of that, the world markets really command the attention, and Canada is now producing its most oil it ever has, and its most natural gas it ever has. We are producing, I believe, 5.1 or a shade over 5.1 million barrels a day of oil. 4.3 of it goes to the U.S. Natural gas, we're not quite 20 BCF a day. But those are big numbers historically for us, and LNG Canada alone is going to take away 15 to 18% of that Canadian production just in phase one, and they're looking to build phase two, increase the capacity, which will take it over 20% of Canada's gas production. So as you can see, again, when I lean on the LNG participation that we've never been in and we're about to participate in, is a big needle mover for our clients and of course, therefore, us and other services, because we're supporting that development in the field.
So the rebound started in earnest 2021. And that's reflected in the performance of Enterprise Group stock. It's been a top performer. How do you foresee the bull market playing out, and for how long here?
Well, my crystal ball is just as foggy as anybody else's. But I think what I've just explained with production now finding its way to other markets other than the U.S., I think is material. I think going forward, the changes that we're going to see. Give me the second part of your question again, because
like the run looks like it's just getting started.
Right.
And the inflection point was getting out of the downturn. 2021, I believe, was the start of the rebound. There's more left, is what I'm saying. There is momentum. So I'm just curious how long this cycle could be if you look out into the future.
Yeah. Sorry, my mind focused on the first part. And anyway, the length or the way we see it. Certainly, I see it. Certainly our C-suite that we talk obviously daily and weekly about. We feel that there's a bit of a global change that's happening. Certainly, since 2014 and how we've developed to where we are today, world looks way different. You can have a look at what's happening with. Certainly, with Germany as a great example. They've spent the last decade, almost $750 billion on renewable electricity generation, and they put themselves in an absolute crisis, and they're desperate for LNG and natural gas because the Russian situation is can't be relied on anymore, and it isn't. They've just got the one line coming through the Ukraine, and that's up for an expiry here in the coming year and a bit. So I mean, these are different demands that are happening globally. Just in the last few years, now more than half of the population of Earth is in Asia. these are third and second world countries that no matter what, they are going to advance and up their standard in living. And when you up your standard in living, you're requiring more fossil fuels. You can look at the data on coal. It's doing this. Natural gas is doing this. Diesel is doing this. All of these things worldwide are on the uptake. I don't know how you can stop that train. It's moving in a pretty, the inertia of it is moving at a good rate. I don't think it's immovable. And we now here in Canada, like I said, I'll go back to, we now can access oil and gas markets globally through these new projects. And that's where I think the needle mover is for Canadian production. I think that's what takes out that, like I said earlier, that lumpiness in the cycles, because we only have ever had one responder as a user and a buyer of our product, and it's been the U.S. When you can sort of diversify that, obviously we feel the lumpiness should vacate itself, certainly from these ups and downs.
Yeah, it does, and as you explained, there's tailwinds still to come, right, in the future. The electrification of the world isn't as advancing as we thought it would, and there's still a big need for oil and gas in the world. 50% of your competitors were gone during the latest downturn. I know you were selling some assets to service debt, but were you buying any during that time? Any companies?
We weren't during the downturn. No, we like I said, we made two disposals, and they were very timely and very good valuations for the company. We made an acquisition in 2000, I believe 20. It was a small company, sort of husband, wife, and brother, and a brother-in-law type thing, and they had. What we were developing, our power system fleet, going to natural gas, they had a very small fleet. They had two, nice names as clients, and they were doing it in a sort of a small way. And of course, they had no ability to really grow it at all. So, of course, we were doing the same thing over at our one power division. And in the end, we ended up buying their assets, brought on their two clients. Now they are big participants in the management of our Evolution Power division. So we kind of just merged them together, and that's really the only acquisition we've done. We acquired the assets, brought them on. They had great expertise in the field work and so forth, and they had a couple of very, very desirable clients. So that's pretty much it for any type of acquisitions. At time and let's face it, it's only been in better times in our Canadian energy sector now for just going on 3 years, and anybody that made it out the other end, it's been pretty difficult. People ask us, well, why aren't there anybody else competing with you with these type of power systems? Listen, this is not an inexpensive investment, and most of our site infrastructure competitors are single proprietor, one maybe two locations. They're not Total Energy or Secure or any of these bigger players. They're smaller single proprietor type operations. And to compete with us, you'd have to get a bunch of electrical expertise, because our business is very mechanical. We've been developing our electrical expertise, so journeyman electricians and master electricians, and even an apprentice program. We're building that expertise up in this division. Somebody would have to start. They'd have to go grab somebody that because these are 480 volt systems. They're not small by any stretch. They take planning. There's code and safety issues to deal with in the electrical world. So that's what I'm talking about. The moat that we're building. We're 5.5, almost 6 years into this process. Not only that, our fleet is got to be. Just in the power generation has got to be 12 15 million in size. And then all of the accessories, the microgrid, all the cabling and distribution panels and so forth. I mean, every system needs about a $250,000 microgrid so everything else plugs in seamlessly. This is a serious capital investment, and many of our players, they just made it out the other end, and they've enjoyed maybe 2-3 years of better times. But certainly that kind of capital, and let's face it, the banking system, very, very stingy these days, especially in the oil and gas sector. Need I say more?
Yeah, it's always a good thing to lose competitors. What would you say your market share is today, Des, and where do you want to go in the next 5 years?
Well, I don't know exactly how, which part of the market share. I mean, in site infrastructure, in the areas, the regions that we're operating in, we have pretty good market share. On the natural gas power system side, we're just at the thin edge of the wedge growing. I mean, we feel we're 15-18% of the sites that we could be on. I mean, if you think about it, in the energy sector in Western Canada, there's hundreds of sites that are out there in remote areas or rural areas running on diesel. Well, we have an opportunity to displace that diesel with natural gas, both either localized supply or compressed natural gas vessels that we bring onto site, basically like a propane, but it's compressed natural gas, and it's still much cheaper, than diesel. So the opportunity to displace diesel is, like I said, we're 15-18% of what we think the total addressable market would be, or opportunity would be, in the energy sector, without looking at the mining world, away from grid construction, any other type of industrial applications where this would apply.
And you made mention of acquiring that most recent acquisition as a mom and pop run company. What's your acquisition strategy going forward to grow and grab more market share? If it's just by factor of acquiring clients that some of these smaller operations have contracts with.
I think as we're obviously like you mentioned at the outset, we're on our 20th year in business. So the energy sector knows our businesses and knows our quality and service and what have you. Going forward, the building this through acquisition and organic, we're looking at both. Obviously, organically is probably the best way for us to grow inside the energy sector in the services world. That doesn't mean there might not be an opportunity that shows its face, but right now we don't have another sort of competitor opportunity in front of us. But we do have a couple of things that we're looking at closely. One of them it'll be more of a new year. We're looking under the hood on an opportunity, and it's more on the power side. So there are going to be opportunities that way. When we look at the mining sector as well, in how we service our energy sector, well, the Western Canadian Basin, where we're producing oil and gas, is really a little chunk of northeastern BC, and of course all of Alberta, a third of Saskatchewan, and a sliver into Manitoba. So you could have 8 or 12 yard and shop locations to service that entire oil and gas sector. But mining, I mean, it's everywhere. It's in Newfoundland and Labrador and northern Quebec and northwestern Ontario. I mean, look what's happening in Saskatchewan with uranium and potash. And BC is an absolute magnet for mining. So it's everywhere. So to service the mining sector is going to take, maybe there's going to be some opportunities. Maybe there's some other mining services companies that have infrastructure that could be opportunities for us to either acquire or partner with or what have you. So there is going to be a set of opportunities in front of us as we build out our mobile, turbine power division. Absolutely. So, and we've made 9 acquisitions in the 20 years we've been in business. So we're pretty skilled at acquiring businesses and integrating them. We've only made 2 dispositions, and we've had some amalgamations along the way. So it would be a good bet to know that Enterprise will probably have some M&A in its future.
You talked about opportunities, but what are the biggest challenges and roadblocks in scaling and growing the company?
Well, obviously, when you got a bit of a tiger by the tail, and so far, having this leadership and sort of first mover advantage in our natural gas power systems, we've been able to, cash flow has been, as you described, you talked about our financial performance since the uptick in 3 years ago. It's been, not only are we increasing 20 and 30% our annual revenues, but we're increasing our margins. And in the services business, we have excellent margins. As we move along, we've been able to fund ourselves through cash flow and our debt facility. We've been able to keep up with that, at times fairly feverish capex, which is due to customer demand. We have a pretty aggressive 2025 in front of us. The market over the last year has been very, has received our business and how we're doing at it. They've received it very well. We raised a tiny bit of money in the spring, about $7 million, and we just finished a well oversubscribed private play. I guess. It was a short form prospectus, and raised $28.8 million. So we feel that our near term needs to fund the growth that we are looking at facing in 2025 and maybe a little bit forward, we feel we're well funded. Yeah. So at the moment, I don't have anything keeping me up at night because of this funding and a few of the things that are in front of us. We're well funded, and we should be able to operate at a pretty good. We should be able to deliver with what we've done.
If we're to go way back, Des, I'm completely curious. I was only in grade 12 at high school when you founded the company in 2004. When you co-founded the company with your partner, why did you do it? What was the opportunity? What was going on leading up to founding the company? If you can talk us through that.
Well, like I said, Len Jarozik and I, we've been working together for about 35 years. Not always every solidly, but most of that time we were working together on a number of business opportunities and real estate opportunities and so forth, and a lot of it in the public market. So we always had a public company or two, and we've started, I believe, 3 or 4 CPCs along the way. So we've been really active. But what was happening in 2003 and 4? We had a very, very robust Canadian energy sector. It was both natural gas and oil were at fabulous prices, and the industry was really, really quite on fire. So we did this CPC. Enterprise was the very first $2 million CPC. Over the years, CPCs were like $250,000 and $500,000. They moved up, and we were the first. Enterprise was the first $2 million CPC. So what we did is we were looking to do a deal on our own instead of funding and investing in other management teams. We thought, hey, let's do one ourselves. So we put Enterprise together as a CPC, and our first acquisition was in the services business. We actually were looking, at the production side of the energy sector, but in the end, prices per barrel for purchase was just racing, and it was just getting out of sight. So we ended up looking at the energy services landscape, and we were able to find our very first acquisition was was a regional pipeline construction business, basically small inch pipeline, so small to about 16-inch in pipeline size. This is what we call gathering systems. So these aren't interprovincial pipelines. It's mostly gathering systems in the production areas, bringing product from well sites to the gathering system plants and so forth. So it's that type of pipeline construction. And we in 2005 we made that first acquisition. About 8 or 9 months later, we made a second pipeline construction in a different region, and we started operating with better efficiencies and so forth. And then of course we acquired the business that was doing the underground utility installations. So it diversified it was the business that was into infrastructure, residential, commercial, and other types of build outs, for housing and industrial parks and so forth, putting in all of the infrastructure for that. So it was a bit of a diversification, and it treated us well, because if you remember, and you mentioned there was a downturn in 2007-8 when we had the worldwide meltdown with asset-backed mortgages and what have you, the contagion that it created. So we had this, we had the oil and gas sector services side, and we had the infrastructure side, and it treated us well. We were able to manage our way through that downturn, which by the time 2010, 2011 came around, the energy sector was back on again. And of course, then we got very, very active on the acquisition front. So once we got a better market, in 2012, we acquired our heating division, which is Arctic Therm International. That was 2012. 2013, we bought the tunneling business, so Calgary Tunneling, CT Tunneling, that we acquired in 2013. And in 2014, we made 2 acquisitions. That's Hart Oilfield Rentals, which is the Alberta section of our site infrastructure. And then later in the year, in 2014, we bought Westar, which is the northeastern BC operator too. So that rounds out how we sit right now with the disposition of Calgary Tunneling and the and CT infrastructure, or TC infrastructure. We are now left with, of course, all site infrastructure. So Hart, Westar, Arctic Therm, and of course we started the new business 4 years ago, Evolution Power Project. So those are the 4 businesses that we're operating today.
So if you can think back to 2004, the competitors then that you're entering the marketplace with, are they still around today?
Well, many of them no, and there's been consolidation and so forth. The energy sector, the services sector, look nothing similar from certainly back then. And they, again, from 2014, it's changed dramatically again. Back in those days, we had Everready, and they were sort of big acquisitors, and they were getting big. It kind of fell down, and they got taken over by Clear Harbors out of Massachusetts. And so names and deals have changed. We've had all sorts of names come and go, but the real graveyard happened in that 7 years, just because times never got better. If you were carrying debt into 2014 and 15, and your debt was significant, you probably didn't make it out the other side, and that's what created a much different competitive landscape in 2021 forward, and how we were so well positioned. It really big difference between us and our peers, that's for sure.
Who are your major competitors today, Des?
Well, in-site infrastructure, it's a mishmash. Like I said, there's no one that's public. The last public competitor that we had, they actually went into receivership in January of this year, so almost a year ago. It was a company called Wolverine, and they had a division that was that directly competed in site infrastructure, and they. Even though times were better, it wasn't enough to repair the debt profile they were carrying. So they've fallen down. So most of our competitors, like I said, are private single proprietor, might have one or two locations somewhere, but there's in the site infrastructure side of it, there's not many like us that have. I mean, we have 8 locations, yards and shops, and in the different regions. You really need to be within a 2.5-hour drive from your client's project site. So you do have to have some properly placed infrastructure to manage your abilities for your clients.
Yeah. So there's an opportunity to consolidate, basically, like you have a leadership position. Does Enterprise Group own any IP patents that you can talk to?
Yeah, when we acquired Hart, the very innovative group. So that was 2014. I wanted to make this point earlier. Because of the industry we're in, and the acquisitions that we were looking at, we always felt that we wanted to be in the specialized side of things. We always wanted to have equipment that was one of a kind or very few of a kind, or that have some patented designs and what have you. Because when you go into the downturn, everything doesn't stop. It's just lower activity. And inside of that lower activity, you want to make sure that you're part of it. So if you've got gear that is one of a kind or it performs or performs things that no other equipment does, like our Arctic Therm flameless heating gear. There's nothing like our large truck units. They're one of a kind in the world. It was patented gear. Patents since expired, but nevertheless, it was very novel. It's just the patent has expired. Now, Hart was very, very good at collaborating with our clients. Because we're in a very specialized industry, quite often there's a need for an ideas developed to build something of this design type thing. So there's collaboration, and quite often Hart in their days, they built an incredible amount of very novel gear, and some of it was novel enough that they were able to patent those designs. When we bought Hart, I think they had 26 or 27 patents. With our Arctic Therm division, there was some patents over the flameless heat and the air path of the generation of the heat and the flow and what have you. So we were able to patent some of these ideas and so forth, and they've been very valuable to us, both at longevity and staying power. Like I said, when times and the economy starts to compress, we were still called to the job, to the work, because of our class of equipment and the quality of our equipment. So the answer to your question is, yeah, we've got an innovative bunch. Now at Evolution Power, we're developing a lot of our own stuff in-house, built for purpose. I actually had a conversation with our patent lawyer just 2 weeks ago on 2 designs that we have that we're seeking to see if it has some viability to get patented. So the answer is yes, there's innovation and there are patents.
So for people who are watching who are new to the oil and gas services space, tell us how you generate revenue. What's the business model? Is this a rental, or you sell the equipment? Is it both?
Right. We don't sell. So everything is on a day rate. No different than, Neighbors and any of these drilling companies, Precision and what have you. Everything goes out on a day rate. Same thing with fracking and so forth. So when we're when they're doing their performing their project sites, they need site infrastructure, and let's explain that quickly. Obviously, I've explained the one pillar, which is the mobile power systems, because these project sites require power. There's no overhead lines. They're well away from any infrastructure, so mobile power is very important. And because these sites, the clients are operating there 24/7. Nobody goes, the site doesn't shut down at 5 o'clock in the evening and everybody goes home and comes back at 7:30. It's 24/7. So power and lighting and office buildings are on all the time. And this is the site infrastructure that we bring out to these project sites. The power, all of the buildings. So they need offices on site. They need command centers. They need, washroom buildings and so forth, and medic shacks and so forth. So all these mobile structures, we have a whole fleet of these that are of different floor plans that they require on site. And then, of course, lighting. Lighting is on 24/7, whether it's June or January, where obviously, up north you have more darkness than daylight, but lighting is on all the time. So those are the three pillars to site infrastructure: power, office buildings and structures for housing, the medic people and the command centers and so forth, and of course lighting. And then of course there's all sorts of other equipment that like I explained, we've built some combo equipment with some innovation and so forth, for specific needs of the clients, and so that rounds out what site infrastructure is. Now these project sites they could last several weeks to several months. If we're drilling and completing, those are couple 3 months at a time. If they're building a gathering system plant or a carbon capture plant, which is now being built at pretty good rates, we're out there for 9 to 15 months, because these are areas there's no power, there's no buildings, so everything needs to be mobile. So these projects, they start and they finish, and we usually go to their next location or what have you, or it comes back to our yard for maintenance and so forth, and out again for other clients. So it's project to project. Yep. Daily.
And as you said, some of these sites are so expansive that the smaller competitors just can't even fulfill the demand for a lot of cases.
It's an expensive fleet, to operate.
And so if we think about site expansion, for the clients that you currently have in your books, have you projected out, let's say, the next 3 to 5 years? Are they planning more locations? Obviously, that would build out your revenue base. Walk me through that.
Yeah. Well, one of the, in planning out 3 and 5 years, the energy sector is historically known for very little visibility. So usually, the producers that are public, like right about now, the majority of them have given guidance on what their CapEx spending for field development, which is, what we do for them. And the majority of them have, again, we've now seen from 2021 and 22, 23, 24, and now 25 is the majority of them are increasing their CapEx again. So the message to us, services players is, okay, this trajectory is still intact. That's very positive. But when we're talking with our clients, it's rare that we'll get more visibility than 6 or 9 months. We understand, that we'll understand their, or we'll get communication on their drilling and completions program and what plant sites they're building and so forth. But they never tell us what they're doing 3 years from now. It just, that kind of visibility is just, it never existed in our industry. So the best we can do is, and how we've been doing it is purely by guiding ourselves on what the CapEx spends are, staying really close to what our clients are saying, reading between some of those lines, because many of them are told, don't say too much, So it's a pretty interesting thing.
In 20 years running the company, Des, what's the most misunderstood aspect do you feel about Enterprise Group in the 20 years that it comes up again and again?
Yeah, I guess one of the things that when we're speaking to the investment community, and it's folks like yourself and private offices and institutional players and fund managers and so forth, quite often the energy sector is looked at as a violently cyclical. Cyclical and violently. So that is in some people's mind, a bit of a rap that the sector gets. I feel, for all the things we talked about maybe a half an hour ago, that a lot of that lumpiness and that those violent moves up and down, barring an event like what Saudi Arabia did in 2014, but these kinds of moves up and down in activity levels and so forth, and what that brings. I mean, when the things happened in 2014, I mean, our clients talked to us and they said, activity levels are going to be a lot slower than they were, and to work with us, we're going to need discounts. And over a period of 7-8 months, it went from here to here,
Yeah.
right? And that's one of the and we never got a chance to talk about it, but you talked about our resiliency.
Yep.
I don't mind patting ourselves on the back because during that 7-year downturn, we realized all this early, which precipitated us disposing of 2 of the businesses. But we sat down with every one of our branches and GMs and sat down line by line. And we still do that today. And we have refined the businesses to be doing a lot more with less. It's one of the reasons we like our business model is because we're not employee heavy. And during that time, we were able to skinny things down and get everything under control. So when the uptick started, if we were able to hang on to that discipline as the market gets better, we will be able to wring out the margin points. And it's evident over the last 3 years of our financial performance. We've been growing our margins, and it's because of our discipline and what we went through that 7 years. Our CFO, Warren Cabral, and his team, really incredible folks. Warren and Doug, VP of Finance, they've been with us well over a decade. I think Doug is now 15 years. So we've got some long-term people that understand certainly what's happened. We're very sensitive to the possibilities and the discipline that we need to keep even in the good times. And the energy sector is, gets a bad rap for that. When things get times are good, commodity prices are high, and things need to be done quickly, and everybody's quick to just make a decision. Well, it doesn't matter what it costs, and that discipline slips when times are good. We're trying to make that discipline have sustainability because it will treat us. And I think we've shown certainly over the last 3 years that discipline is showing in our financial performance.
Absolutely. So I have a question about the board of director composition. Before I get there, I just thought, I'm going to go back to the early beginnings because I'm curious. Who was the first major customer that you won all the way back then, 2004 to 2005? Yeah.
Good question, and lots of good stories about it. So our first acquisition, if you remember, I said it was a pipeline construction company based in Slave Lake, Alberta, and they were in the business of building small inch gathering system pipelines, and we won a bid up in the Wabasca area, which is just north, and it was Canadian Natural Resources, so CNQ symbol. Obviously, there were giants back then. I mean, they're further giants today.
Canadian Natural Resources, yeah, huge.
Yeah, so they had their South Britnell field, and they were drilling and developing their production there. And of course, we were keeping up with building the pipelines to hook up the wells to the plants and so forth, and building the plants. So it was certainly there was others, but that was the big one. That was that
was huge. I'm sure you cracked open the bottles of champagne, right, that night.
Yeah.
Really
and
exciting.
It's interesting, CNRL being, back then they were kind of known as bullies.
Oh, really?
They'd our experience with CNRL back then was much better than many of the stories in the sector. I mean, in those days they would take a long time to pay, and if you were small and weren't well capitalized or have a decent amount of working capital, they could wear you out, right? And they did. We didn't have it unfortunately that bad, but in today's world, see what's happening now is. Comparatively speaking, 20 years ago, everything was a field ticket. It was actually, a ticket that was handwritten. You get the superintendent from, the producer to sign it on site, comes back to the branch office and finds its way down to Calgary, goes up through, and, it could take, it was not unheard of in our sector to get paid, 75 to 120 days later. Well, today, all that nonsense is gone because there's electronic field ticketing. Everything is electronic. Tick, tick, check, sign, DocuSign, immediately it's in the servers in Calgary. So, the world today is more like of a 45, 50 day payment period, which is a lot different than 75 and 120. So those days are over, but I'll tell you what, they wore a lot of businesses out, I'll tell you.
That's an interesting story. Well, why would you walk away from a new customer or contract today, Des?
Why would you? I'm trying to, we've never done that. I think the only thing that come to my mind after telling this story would be abuse. If you're absolutely abused by the client, how much more could you take of it? But I think, everybody's first answer to the client is yes. You're willing to do it because, when in our business in the energy sector, you never want to lose a client because it's impossible to get them back, right? That's why we've sort of engineered our relationship or how we have a relationship with the client to make it bulletproof. So we're not making any type of mistakes or perceived mistakes where they give you a reason to chuck you out. So it would be absolutely rare to lose a client for us, or I'm trying to, in my head, go back and see if we ever walked away from anybody for some reason. I don't think we have.
There's been no issues about profitability through the negotiation process. You get to a good point, it sounds like.
Yeah. And generally speaking, in our sector, there's pretty good level heads. I'm pleased to report. Yeah, pretty level heads.
So last question, the board composition. Can you tell me about others on the board and the skills they contribute to the company?
Yeah. I like our board. Obviously, Len and myself are two of the five. Yeah. Obviously, we're not independent because we're officers of the business, but the other three are independent. Starting with John Pinsent, who is not only a CA, he's an FCA, so he's been brought into the Fellowship of Chartered Accountants. He is on the exit side of his firm. He's an owner with two other partners of a very well-known firm in Edmonton. So very, very, and he's also a credentialed with the director. Can't remember, but you know how they you take the courses on directorships and governance and compliance and what have you. So both John Pinsent, who I'm talking about, and John Campbell, who I'll next talk about, they're both credentialed that way. So John Pinsent has been with us, I believe, maybe 14 years. John Campbell, I believe maybe 11 years now. John Campbell, also a CA, but he has a history that is a little more on the portfolio management side and M&A. So some years back, he was Jimmy Pattison's lead M&A player. Like right-hand man on his M&A squad there, and that was late 70s into the 80s. Then he got into portfolio management. That's how we met John. We were actually doing a marketing trip for a financing that we were doing back in 2012 or 13, and we presented to him, and he was extremely intuitive to what we were doing, had lots of advice. Explained a lot of things. It was a meeting that was unlike the others. He had something of value to talk about in those meetings, and we never forgot about that. When there was an opportunity, we had a seat that needed to be filled. We reached out to John, and he came on board, and he's been here ever since. And I think it dates back now 11 years. And then right around the same time, we brought on Neil Darling. Now, Neil Darling, out of all of our independent directors, he's the industry guy. So he is a drilling engineer. He is a highly regarded technical guy, especially for very, very difficult, deep and high-pressure wells. He is a guy that founded Ramdar Engineering, and he's our industry guy. So he walks the hallways of all of those, developing drill engineering and so forth. So his clients are many of the same as ours, but obviously he's in the drilling side of things. I have a relationship with Neil. We were involved in a resource play that he was brought into to rescue a very, very technical drill down in the middle of California. And I met him in 1998. And we've had a sort of a business friendship that became a personal friendship. And when we had an opportunity for a seat open, we invited Neil on. So he's our industry guy. He's a guy, like I said, walks all the hallways, knows things that are going on before most others do, and he's a very, very technical mind as well. So we round out that independent board with very, very strong on the numbers and accounting side, obviously, and the governance side and compliance. And then, of course, we have Neil, who's on the industry side. So we feel we're in the right spot, the content of that board.
Oh, thanks for explaining it. The governance does sound very well-rounded for Enterprise Group. I appreciate your time, Des. Thanks very much. I learned a lot about the business, and I wish you well.
Thanks so much. Thanks for having me. It was a gas.